Session, I'm going to look at different trading strategies which can be performed using the options. So, agenda wise, I would be looking at first the basic strategies where I talk about a single option, either a call option or a put option. Strategies that involve a single option plus the underlying stock. So this is one kind of strategies. We'll look at how a call option can be used along with the stock, how a put option can be used along with the stock. Then slowly I would be moving on to cover the spread based strategies, wherein we talk about the more common kind of spreads being the bull spread strategies, and we look at the bear spread strategies. We will also talk about the butterfly spread strategies, then a little bit into the understanding of calendar spread as well as the diagonal spread. Calendar spread and diagonal spread kind of strategies also. All these will go as a part of the different spread strategies. We'll talk about them. And finally, I would also talk about a few combination based strategies. Right? What are these strategies we'll talk about? But the common names being straddle, the strangle, and strip and strap. All these kind of strategies is what I would like to cover as a part of this particular session. And to do this, all of these, I would be typically using a spreadsheet with the data directly picked up from the trading website, from the exchange website, and we'll take the numbers for one single stock. Probably we'll take different call options that are available, different put options that are available, and based on them we'll try to construct the strategies that can be performed using the option. Now for that I have taken one simple data from National Stock Exchange, the Indian stock based derivatives exchange market, wherein I have taken a stock, okay, whose current stock price, the Infosys as a stock is what I've taken. Let me carry some of the important data to the spreadsheet. Okay, I'm taking the security as Infosys, whose current stock price, the current stock price is 3613. Okay, the stock price as of date is 3613. Let me take that number as it is. Then, so to demonstrate all these things, I would like to have a few call options. So because the price is 3613, I'll take the 3600 as at the money. Right? These are the different strike prices that are available for the call option, and this side it is for the put option. Now what I would like to take is 3600. I would like to take it as the at the money call option. Okay, so I'll take ATM call. The strike price is 3600, and what is the call price? The call premium for this 3600 is 50.15. Okay, for simplicity purpose, let me assume that it is 50. I'll call this as the strike prices, and these are the premiums. So for ATM call, which is 3600, strike price is currently available at a premium of 50. Similarly, ATM put, at the money put, with the same 3600 strike price is available for 46.25. So I'll round it up to 46. Then I'll take two ITM calls. I'll take two ITM calls in the money calls. One for a strike price of 50 less. So probably 3,600. So 3,550 and 3,500. I take two of them. So let me take 3,550 and even 3,500 for some specific purposes. Probably we can think of using them. So the 3,550 call is available for 81.55. So let me take it at 82, and the 3,500 one is available at 120. All right. So ITM call 1, let me call it, and this I'll call it as ITM call 2. Similarly, I'll take ITM put 1 and ITM put 2. Now here also I can use the same logic, but puts in the money goes with if the strike price is keeping on increasing. So I'll take 3,650 as well as 3,700, right? So 3,650 strike, 3,700 strike. 3,650 strike is available at 75 and this is available at 120 again. So this is available at 75, this is available at 120. Fair enough. Similarly, I would look at one OTM call, or probably let me look at two OTM calls. If I require, I'll use them, otherwise I will not. Similarly, I'll take OTM puts also, but at least one is definitely required, so that's the reason I'll have one at least. But yeah, the second one is always for a safety purpose. So this for calls, I will, as the strike price is increasing, it becomes out of the money. So I'll take 3,650 and 700. Whereas in case of puts, I take 3,550 and 3,500. Let me note down what are the premiums. 3,650 and 3,007. The call is 31 and 18. Okay, 31 and 18. Whereas for puts, 3,550, this is 27 and 16. Correct? 27 and 16. Alright. And what is the other additional information that I require now? The current date. What is the today's date? As per my system, it is 16th August 2014. And the expiry date of the option is 28th August 2014. Alright. Then I also require, I think these should be sufficient, and probably I need one more for yeah, let me work out with these, or probably I require for 25th September expiry. Is there any much of a trading here? We don't see too much of a trading happening associated with the next expiry, so there's no point in getting into them right away. Yeah, but these are the typical information I can start off with. Right, so I've taken different call options that are available in the market and different stock prices, different put options. Now with them, I want to create a few option trading strategies to work out. Alright, so the first one, especially I'm starting off with a single option based strategies. Right, so the first thing I would like to look at is single option based strategies along with an underlying stock. Right, so the first strategy which I am talking of is writing a covered call. When I say writing a covered call strategy, We are talking about a long position in the stock plus short position in the call. Right? This is what we call as writing a covered call. Okay, let's see. One long stock. So when I am talking about a covered call strategy, we are talking of one long stock, one short call. The way I would like to work out all these things is straightforward. Okay, let me take these strategies somewhere towards this side. One long stock plus one short call. That is what we are calling as a covered call strategy. All right. Now, if I had gone long on the stock right now, what could have happened? I would have, it's assumed that I am purchasing the share at 3,613 and I have sold a call option, right? Okay, let me take for the choice. I have sold a 3,500 call option. So I have sold a 3,500 call option, or probably I have sold, let me take it as 3,600 call. Okay, I have purchased the share at 3,613 and I have sold a call option for 3,600. So that is where let me note down the numbers. So I have taken one long stock I have done at 3,613 and let's say one short call I have done an ATM call itself. Now the way I would like to work out the profit positions always is, what if the stock price goes to different things on the expiration date. Let's say the stock price goes right from 3,500. Right, I'll take the scenarios right from 3,500 or probably 3,400 onwards with a 50 increase. With a 50 increase across. Right from this, let's say if the stock price, is taking a route up to 3,800 or 3,850. Let's say if these are all the possible prices on the expiration date. Now, what are the profits here? I have gone long on the stock at 3,613, but the share price on that particular day is 3,400. So there is a loss for me to the extent of 213, because today I have purchased it at 3,613. On that day it has become 3,400. So there is a loss for me for 213. So these kind of things I could have represented as this minus this. So directly I am getting the positions. Probably if the market price has gone to 3,700 on that day, I would have gained 87 bucks. That is what it is showing. Now, then I would look at one short call. Means I have sold the call option. The person who has purchased the call option, he will have the option to purchase the share at 3,600 if he wants. If he wants, he can purchase the share at 3,600, otherwise he can expire it. Which means if the market price is below 3,600, he will expire it. So what I will typically do is, if the market price is less than the whatever is the call option price, if the market price is less than the call option price, it is the buyer is going to expire, so the seller is not having any kind of a gain or a loss on it. So if it is less than this, I will directly take the benefit as zero, benefit or loss as zero. But if it is more than it, obviously the seller, the buyer of the call is going to exercise it, which means he is going to buy the security from you at 3,600 bucks, which means the difference is a kind of a loss for us. So that's where I am positioning the loss as this number minus whatever is the price. So by shorting it on the maturity date, the profitability position is going to be something like this. Here there is going to be a loss of 50 bucks because 3,650 is the market price, but I have sold a call option saying the person who has purchased it can very well purchase the share from me at 3,600. So he's going to go ahead with it, which means I'm going to have a loss of 50 bucks and so on. But because of the short call, I could have received a premium, which I would have received today. Because of the short call, every short call there is a short or long, any option positions that are there. In short position, the premium is received. In the long position, the premium is paid. So that's where I will say, because this is a 3,600 call, the premium is going to be 50 and I am going to receive this premium. So there's going to be an additional stuff going up. So in this case, what I could see is the premium is going to be 50 in all the cases, and this is where I'll try to find out the total profit. The total profit in each of the cases, if the stock price is going to any of these scenarios, the total profit in each of these cases for me is working out to something like this. So this is the profit in different kind if the stock price is touching different kinds of levels. So if I try to plot a simple graph taking the stock prices on the expiry date and the total profits, let me see what is the kind of chart I'm going to get. So this is the typical chart that we are going to get. So this is the typical chart that we are going to get, which shows that if the stock price goes below 3,650, which is nothing but the premium as well as the strike price. If the stock price goes below 3,650, then there is going to be a loss. If the stock price is above 3,650, what we are typically seeing is there is going to be a profit or no profit, profit of 37 bucks. 3,650, there is going to be a profit of 37 bucks, but anything below this 3,613, sorry, which is the stock price, below 3,613, I could see that the profits are falling and slightly let's say below 3,000. See the typical location where I am seeing 3,587 here. At this particular point where it is 3,587, the break even is occurring, and after that I am seeing that the losses are mounting up. The losses are going even to the extent of unlimited 163 in this particular case. So this is like a covered call strategy. What we are simply saying is This is looking similar to writing a put option. This is similar to writing a put option. So instead of writing a put, the person could have gone for a covered call strategy as well. And in this case, what we are seeing is the long stock, whatever the share that has already been purchased, it is doing a protection from the payoff that is coming from the short call. The long stock is doing a protection from the payoff that is coming from the short stock fall, provided if the share price is rising drastically. If the stock price is increasing drastically, there is going to be if there was no call option, let's say you have written a call option. Because of the writing of the call option, if the stock price has increased, let's say you have sold a call option only. So when you have sold a call option, you are going to get a benefit when the stock price is falling. When the stock price is falling, you are going to get your premium. But if the stock price is increasing, there is a huge loss that's going to get mounted up. So to protect yourself against that huge loss that is getting mounted up because of the short call strategy, we are going long on the stock to protect ourselves, and that protection is typically giving us a kind of a flattened platform at the top. Even if the stock price goes to anything up, I'm typically going to get some kind of a benefit out of it. My loss is getting mitigated to a large extent. This is what we call as a writing a covered call kind of a strategy. And of course, if I go the other way, I call it as reversing the writing a call strategy. I go the other way means I go short on the stock, I go long on the call. Exactly the same. So these numbers, the negatives will become the positives will become the negatives, and the graph would be exactly a mirror reflection over the x-axis. So that is like reversing the writing of a call kind of a strategy. So I'm not looking at it, but one party which has written a call, the other party written a covered call, the other party could have gone in terms of reversing a covered call strategy as well. Then the next of its kind of strategies which I am more interested in looking at is a protective put strategy. Here also, the way we talk about is one long stock, just like a covered call, but one long put also, where there is a one long put premium is like a call out, is like a outflow for you, right? So initially when we look at this strategy, let's execute the same. One long stock, I'll take it exactly the same stuff. One long put also, I'll take the strike price. I'll take the strike price of the put. I'll take ATM put itself. The premium for it is going to be 46 bucks, but because it's a long position, it's a kind of a cash outflow for me. Fair enough. So these are the numbers that are there on the beginning of the contract. And now what I'm talking of is if the stock price touches any of these numbers on the expiration date, if the stock price touches any of these numbers on the expiration date, in this case, the same case, there is going to be a loss to the extent of 213 bucks, right? And this is not changing. And what will happen when I have purchased a put? It gives me the right to sell the stock at 3,600. If the market price is 3,400, if I am able to sell it at 3,600, I am going to get a profit of 200. So that's where, and I'll try to exercise this put only when the market price is lesser than the strike price. So that's where I'll say if the market price is lesser than the strike price, exercise it. And when you exercise it, you'll get the difference between this and this. You'll get a gain which is a difference between this and this, and in case you are not exercising it, you are not going to lose out anything on it. So the gain in this case is going to be 200, and probably after this the gain is getting disappearing, because if the market price is 3650, the long put will not be exercised. So because it is getting expired, there is nothing that is coming out. And premium wise, the same amount has been incurred in all the case, because on day 0 when you have entered into the contract itself, the premium has been tied up. And because of that, if I am trying to compute the total profit that is involved, depending on whatever the stock price on that particular day, what we are simply observing is, in the first case the profit is going to be minus 59, and slowly it is going towards positive. So as the stock price is increasing, the profit is going to be coming up. So if I am trying to put again a simple chart which can help me understand the same flow, I could see that in this case the profits are following some such kind of a pattern for different market prices on the expiration date. So this is looking like a long call option position itself. So a protective put for me is like one long stock plus one long put. This is looking like one long call itself. I am going for a call option. This is the shape that is associated with a call option itself. As long as the stock price is lesser than this 3613, I am going to get a loss of 59 bucks, and as long as the stock price is going beyond or above this 3613, sorry, 3613, the loss is reducing and a profit is going towards more and more unlimited kind of a stuff. So without even taking a call option, without even getting into a call option, I could create the situation of a call option by getting into a protective put kind of a strategy. And so this is one more important strategy which replicates something like a call option. The loss is mitigated to the extent of only 59 bucks, but when there is a profit, there is going to be an exceptional profit. The profit is going much on the higher side as well, right? So these kind of strategies typically fall into the single option kind of a strategies clubbed with the underlying stock. All right, now we will slightly move on to strategies where at least two or more calls or more puts are involved. So initially we would focus on spread strategies where we talk about two or more options of the same type. So either calls or puts. Whatever I look at with calls, I look at with put, but both of them should be of the same type. I can't have one call and one put as a part of the spread strategies. They are all either two calls or two or more calls. In some cases we talk about four calls also, but whatever it is either fully calls or fully puts kind of strategy. They are all classified as a part of the spread strategies. All right. So in that context, initially let's start off with what we categorize as bull spread strategies. So in the bull spread, we talk about, initially when I am talking about calls, I call it as bull call spread strategy. Here we talk about one long call. Now here we don't have underlying stocks. We talk about one long call at some strike price, but one short call. So this is the strategy that is going under the bull call spread. One short call at at the higher strike price. Whatever the strike price I am buying, the long call is at a lower strike price. The short call is at a higher strike price, and both of them will have the same expiration date. So those are typically classified as bull call strategies. Okay, we'll see what is happening in that kind of a strategy. So I'll take it as a bull call spread strategy. The same thing we can use it for puts also. So in this case, as I said, we were talking about one long call and one short call position. So because I have taken a long call, I'll get long call, there is a long call premium involved, and because there is a short call, there is a short call premium also involved in it, right? And associated with all these things is what I want to find out, the total profit. All right. Now again the same logic. I want to know long call, what strike price. I'll take the long call this time at 3,550. Let me take the long call at 3,550, but a short call should be at a higher strike price, so I'll take it at 3,600. So because of that, the long call premium, whatever was the 3,550 call, the long call premium was 82, and because this is 82 we are talking about, and it's a long call, it's a cash outflow, so 82 is the payment, and we are talking about a short call, 3,600 calls, so I'm directly getting a cash inflow of 50. So the net wise, there is on day 0 there is a cash outflow, so there is a kind of an initial investment that is involved of $32 bucks. Whereas if there has not been a short position, probably there is an initial cash outflow of 82 rupees, but now there is a cash outflow of only 32 rupees. That's one side of the story. Now look at what if the stock price on the expiry date touches any of these situations, goes anywhere from 3,400, let's say, to 3,800. First of all, the premiums wise there will not be any change, so let me directly take these numbers as it is. Even this premium will not change, so this also would be as it is. Now look at the long call. I can buy the share at 3,550 and I will execute it definitely if the market price is more than 3,550. So if it is less than 3,550, I will simply expire the call option, giving me a benefit of 0. Otherwise, I will execute it at 3,550, which is going to give me a benefit of the difference. Okay. So it is going to give me the benefit of the difference. So I'm simply, initially when the market price is 3,400, I will not exercise it. But when it has gone to 3,600 or 650, I am exercising it, giving me this kind of profits. Similarly, because I have shorted it, the long will exercise it only if the market price is greater than this, and then a loss is going to come up for me. So I will say if this is greater, if this is lesser than the strike price, the long position is not going to exercise it, so there is no loss for me. But if the long is exercising, then the difference is what is coming out as loss for me. So that's where I am exercising this as a loss if the market price goes beyond 3,600, which is the strike price. So that's where we are saying if the market price goes to 3,650, there is going to be a loss of 50 for me, because the long is going to exercise the option, purchase the share at 3,600. So the market price is 3,650. So that 50 is what is causing as a loss to the short call position. Now I can talk about the overall profit or loss situation. Minus 32 staying on, and it's going up to plus 18 kind of numbers. Now if I am trying to plot the same in the form of a graph, I'm going to get a chart something similar to this kind of a shape. A very interesting shape, which is telling me that both the profit as well as the loss are capped. The loss is nowhere below 32, the profit is nowhere above 18. And because the profit is coming when the market price is going up, we call this as a bull spread strategy. The market is improving, or when the market is growing, the profit is getting generated. When the market price is falling, the loss is getting generated. And that is the reason we call it as a bull call spread kind of a strategy. Now here it's like a protected position altogether. Both the loss is prevented, but we have to sacrifice the profit also from that standpoint. And as we know, the higher strike price will always be available at a lower cost. Initially, there will definitely be a investment in this kind of a strategy. 32 rupees has to be invested in this kind of a strategy, but it limits both the upside as well as the downside. So it's like, okay, I have a call option, I've sold a call option, but in a typical selling of the call option, the loss is unlimited. And to protect myself against that unlimited loss, I have gone for a long call option for a lesser strike price. So that is what is the protection that I am getting. The loss cannot go beyond 32 in any case. So typically we can work out with this kind of a strategy, especially when we are observing that we have initially written a call under the assumption that the market price will go up. But when we are observing that the market price is actually not going up, but it is falling, and because of that I'm getting subjected to I'm getting subjected to a very probably I can look at, I've written a long call, and in that long call I'm actually paying a premium of 82 bucks. Let's say I've started, okay, let's start off like this. I have gone for a long call position initially, but that incurred 82 as the maximum loss. But I'm expecting the stock price to typically go up. But at the same time, I want to prevent myself against the downside, because if at all the stock price goes down, I'm going to lose 82 bucks, which is going to be significant. I wanted to minimize that typical loss by getting into a short call wherein I'm able to collect a premium of 50 bucks, and reduce my overall downside position altogether. So I'm giving up my upside potential in case of a regular call. In case of a regular call, there is going to be an unlimited upside. But I'm trying to give up my upside potential, but at the same time I'm trying to protect my downside for it. So these are what typically go as a part of the spread strategies. We are calling them as bull call spread strategies. Typically the way we can operate out there is, I can create a situation where both the calls are in the money. One call could be in the money and the other one could be out of money, or I can have two calls out of money itself. Let me talk about the example where I am taking two calls out of money itself. Let's see how the situation is going to move there. Both the calls are out of money. 3650 call and 3700 call. Let me take those two. 3650 call, 3700 call. And this 3650 call is available to me at a premium of 31, and 3700 call is available at 18. So 31 and this is available at 18. Now you see the initial cash outflow is only 13 bucks. The profit potential has gone to the extent of 37. So if at all I am making a loss, the loss is going to be only 13. But when there is going to be a profit, the profit is getting frozen at around 37. So that is one kind of a scenario where we are looking at the spread is becoming more and more conservative in this case. The same logics I could have executed with respect to the put option also, where I go long on a put. I go long on a put at a particular strike price. I go short on a put at a higher strike price. But what is going to happen in this case is, when I'm for the put option, as the strike price increases, we have observed that the option price also increases. So I'm shorting a higher strike price one, which means there is going to be a cash inflow for me in the beginning itself. In case of a bull call spread strategy, I'm going to have a cash outflow in the beginning. But in case of bull put spread kind of a strategy, I'm going to get an upfront cash inflow, and the final payoff is going to be either negative or positive at a later point in time, right? But even in case of put also, I see that the profit is going to come up when the market is bullish. Otherwise it's going to it's going to be a kind of a loss. So in any bull spread strategy, the investor is of the opinion that the market price of the particular stock will typically increase, but at the same time he wants to protect himself from the typical downside potential. That is where a bull call or bull put kind of spread strategies are working out. But when an investor is more or less bearish about the stock price movement, then he could very well execute one of these bear spread kind of strategies, which is almost reverse to a bull spread kind of strategies, as simple as that. Probably in the same logic, when I go for a bear call spread strategy, I'm talking about one long call but one short call. This time the same long and short, but this time the long call position will be of a higher strike price. So I'll take a 3700 call to be a long and 3650 call to be a short. And okay, because of this there is a long call premium I'm trying to create, What is the long call premium? Because it's a 3,601, I'm having a cash outflow of 18. And when I talk about the short call premium, because it's a cash inflow, I'll have 31 directly. 31 is going to come up for me. Now, if I check out what is going to happen for different market prices on the expiration date, all I could see is, okay, a long call 3,700, I will exercise it only if the market prices crosses 3,700. So when the market price is below 3,700, there is no payoff coming up. But the moment it crosses 3,700, the difference between the market price and the strike price comes out as the payoff. So in this case, the payoffs are coming out at this particular point. Similarly, in a short call position also, the long will not exercise it until the market price crosses the strike price. So as long as it is less than the strike price, the payoff is going to be zero. But after that, it's going to be a loss for me to the extent it's going to be a loss to the short call position to the extent the market price is above the strike price. So going with that kind of a concept, what we are seeing is the short calls positions are going to be something like this. The premiums wise, there is not much of a change. The long call premium and the short call premium. Out of this, I can very well compute the total profit in all these situations, which is working out to, initially there is a profit that is getting made, and what I could typically see when I am getting into a graph plotting in this case is, as the market price is increasing, I'm seeing that a loss is getting piled up. But if the market price is falling, a profit is getting created. So that's the reason when we are bearish on the market, there is a profit opportunity that is getting created. And that's the reason we are calling this kind of a strategy as a bear call kind of a strategy. When the market is bearish, a profit is getting created. Right. So here, because we have purchased a call whose strike price is more, the cost that is involved in it in purchasing a high strike price call is lesser than the cost that is involved in a low strike price call. So I've shorted a low strike price, I've purchased a high strike price. So the net is going to be a cash inflow in the beginning itself, right? And anyhow, if the stock price is increasing, there is a loss, but the loss is capped only to the extent of 37. It's not going beyond 37 in any case. So even in case of this bear call or bear put kind of strategies also, what we are seeing is both the upside profit potential as well as downside risk, both are typically getting minimized, both are not existing. There is a kind of a limit in which the profits as well as the losses are operating, and what we could see in all these cases is the limit in which the profits and the losses are operating is equal to the difference between the two strike prices, 13 and minus 37 here. The difference between the two strike prices, 3,700 and 3,650 itself. Right? So these are one more kind of a spread strategies which we need to be comfortable with. And then we'll move on to the other kind of spread strategy, which is typically called as the box spread strategy. Very interesting one. When we talk about a box spread, we combine a bull call spread. We combine a bull call spread with a bear put spread. We combine a bull call spread plus a bear put spread. Let's see how this box spread strategy works out. So bull call, so which is like one long call, one short call, that is a bull call. Bear put, one long put and one short put, right? And these are the four that are involved in it. So there is a long call premium, short call premium, long put premium, short put premium. Alright, well, we need to understand all these dimensions now. Okay, let me talk about a long call being done. We are talking of a bull call spread strategy. So we talk about on the higher side, selling a high strike price call, purchasing a low strike price call. Okay, so one long call at 3,650, one short call, I'll take it for 3,700, one long put also I will take at 3,700 because I'm talking about a bear put here. So in case of a bear put, I'm looking at a higher strike price put to be longed and lower strike price put to be shorted. So the premiums wise, I could see in case of one long call, the 3,650 call is available for 31 bucks, and because I'm doing a long call, it's a cash outflow. And the 3,700 call shorted, getting a premium of 18. Similarly, the long puts also I will look at the same 3,650 and 3,700. The long put is 75 and 120. These two puts are costing 75 and 120. So what I could easily do is, this is a long put for 3,700, so I am going to incur a cash outflow of 120 bucks, and a short put is going to incur a cash inflow of 18 for me. 75 for me, because we are talking about a put. So these are the cash inflows and outflows that are typically coming out. And now I could look at what if the stock price goes to any of these things on the expiration date. So I'll look at it until 3,800. Alright. Now the premiums wise, it's already known that in each of the cases, the premiums, the net premiums are going to be something like this itself. Alright. And so initially we can talk about total profit. The first on the outflow, it's only the premiums. So there are two outflows, there are two inflows, and the net is looking like an outflow of 58 bucks. But let's see what if the stock price goes to any of these numbers on that day. With respect to a long call, the long would be exercised only when the market price is greater than the strike price. So until that time, the market price is going to be lesser than the strike itself. Okay, lesser than the strike. So which is going to be, otherwise the difference between the two is what is going to be the gain on the same. Alright, so this is going to be the gain. Similarly, a short call, also the call would be exercised if the market price is lesser than the strike price. If the market price is lesser, it would be expired, so the call would go worthless. Otherwise, the loss is going to be to the extent it is lesser than the market price. It is lesser than the market price. So the losses are going to be something like this. Similarly, in case of put, what we see is if the market price is lesser than the strike price, the put would be exercised and the profit would be to the extent of the difference between the put strike price and the market price. Otherwise, it's going to be zero. So initially there is a profit of 300 that is getting created if the market price is 3400 and so on. And similarly in case of short put also the same logic. If the market price is less than the strike price, the loss is mounting to the short position because the long would be exercising the put. So the loss would be mounting to the short to the extent of this. Otherwise there will not be any kind of a loss potential. So overall, now when I am looking at the overall profit that is coming up in this strategy, it is working out that across the loss is going to be 8 itself. Means everything is going to be flat. The payoff is going to be a flat 50 in all these cases. Only the case is probably in this case what we are seeing is the profit is always minus 8 for this example. Probably in some other examples it may come out that it would be more on the profitable side itself. So probably if I look at, let's say here also the same, in some cases what could very well happen is the prices would be structured in such a way that in any case there is going to be a profit that can get created instead of minus 8. Okay, here because this is minus 8 in all the cases, or what I could have considered is I could have shorted the box spread. Instead of going long on the box spread, I could have shorted the box spread. What does that mean? I could have gone for a reverse box spread strategy. So the reverse box spread is actually talking of this call to be shorted, this call to be long, this put to be shorted, this put to be long, which could have given a profit across of $8. So which is more like an arbitrage profit opportunity that is getting created. But of course, if this profit is only significantly large, it can be exploited because in all these things we are making assumption of no transaction costs, no taxes. So if they are there, this opportunity may be nullified out. So that's how we can take the advantage of the box spread strategy to typically uncover the arbitrage positions and probably exploit the arbitrage positions as they come up, right? So that's one kind of a strategy. Then the other one I'm looking at is a typical butterfly spread strategy. Here we take off 3 strike prices. We talk about one long ITM call, one long OTM call, and 2 short ATM calls. This is what we call what is called as a butterfly spread strategy. So let's see how this strategy is going to work out for me. I call this as butterfly spread, wherein I talk about one long call, 2 short, one long ITM call, 2 short ATM calls, and one long out of money call. These are the things. So long ATM call premium, long ITM call premium, long ATM call premiums, long OTM call premium. These are the numbers that are involved. So we are talking about ITM call. So I'll take it as 3,550 as the strike price. 3,600 I'll take the strike price here. 3,650 I'll take the strike price here. Okay, 3,550 call. What are the premiums? 550, 600. So for 600 the premium is 50. For 3,550 it is 82, and 3,650 it is 31, right? 82, 50 and 31. So these are the numbers, let me remember. So this is going to be 82. So because it's a long position, I'll take it as minus 82. And this is going to be minus 31 because this is a long position. Whereas this, which is at 50, it's a short position, and there are two such. So one is giving me a 50 bucks, so two are giving me 100 bucks as the cash inflow. So initial cash flows, when I am looking at, in this case the initial cash flow is working out to the extent of minus 13. So there is a kind of a cash outflow. But I will be checking out what if the stock prices touch any of these numbers on the expiration date. That's what I have been tracking. So the long call would be exercised only if the market price is greater than the strike price. Until that time it's going to expire, and after that it's going to give me a benefit of the difference between the two. Okay, so this is what is the payoff of the long call position. The same logic I'll execute even for this call. If this stock price is lesser than the strike price, no benefit. Otherwise, it's going to be the difference between these two. So in this case also the profits are working out to some of these kind of numbers. And in a short position also the exercise would be done by the long only when the market price is greater than the strike price. So until that time it is going to be a zero payoff for either of the parties. But once it is greater, here now I am talking about doubling it because I have two short calls. So I'll take it as twice that of the difference between this price and this, or probably the other way, because I'm shorting it. Yeah, the loss is going to be the difference between the strike price and the stock price. All right, so this is what is going to be the loss, and in each of these cases obviously there is not much of a difference. The payouts are going to be the same across. The premiums are going to be same across because they are already incurred at the time I have gotten. So my total profit in each of these situations, what I could see is initially it is minus 13, and even later point it's minus 13. Only in the middle it's somewhere at 37. So if I am actually plotting a graph for the same, it's showing something of this form. It's showing something of this form for me, which is a very clear-cut message that is going in, that during a very small interval, 3,500 and just below 3,500 and just above 3,600, that's the only range in which we can really make profit. But anything widely fluctuating, there is a loss, but the loss is limited on both the sides. The loss cannot go below 13 in any case. So this is what is a kind of a strategy where we call it as a butterfly spread kind of a strategy. Generally, I do the shorting of ATM calls. The long will typically go with ITM as well as OTM. one ITM long, one ITM, one OTM long, but two ATMs would be typically shorted. So a small, so if the stock price is very much close to the ATM, if the stock price is very much close to the current price, which is the ATM price, there is a chance of making a profit, which means if the today's stock price and the expiration stock price are more or less similar, when you don't expect too much of volatility on the stock, we can think of using this strategy. We can think of making a profit. But if the stock goes volatile in any of the directions, either towards the lower side or towards the higher side, there is going to be a loss, but that loss is also not going to be that significant. So especially when when I am of the belief that the stock price is not going to be that volatile, but in case it is volatile, I want to protect myself, I can think of going ahead with this kind of a butterfly spread strategy. The same logic we can work out using even the put options as well. So this is what goes as a part of the butterfly spread strategy. And what we could typically see is these all are more and more applicable, or they make a lot of sense if all these options are European in nature. So the initial investment, whatever is this number, will more or less remain the same even if I am using the calls or puts, because of the call put parity relationship. To a large extent, I see that the initial outflows should be more or less the same if I am going ahead either with a call or a put kind of a strategy. And the reverse, exactly reversal of this also can be done, which means I could have shorted ITM call, I could have shorted OTM call, and I could have gone long on two ATM calls as well. Even those kind of strategies can very well be worked out. Then, see, till now, when I'm talking about a bull call or bear call spread strategies, we have whatever we have used till date, they are like expiration dates are same expiration date, but the strike prices are different in all these examples, right? Even the typical butterfly strategy which we have just now used. But on the other side, when I go ahead with a calendar spread, we talk about the strike prices generally remaining the same, but the expiration dates are different. So it's as good as saying I'll go short, I'll take a short call on a short maturity option, early maturity kind of expiration date, whereas I'll take a long position in the call on later maturity. So this kind of combinations can be created using a calendar spread strategy. Directly we cannot give these kind of payout diagrams, but a straightforward way which we are talking of is whatever is the strike price which we are talking of, I'll take a short position in a call and a long position for the same strike price but for a longer maturity kind of a duration. So in this case, what is happening typically also, if the strike price is same, the longer the maturity period, the premium is going to be higher. So the long call premium is going to be higher than the short call premium. So initially there is a cash outflow in the process, fair enough. There is a cash outflow in the process, and if the stock price at the expiration, so here we always look at the short maturity expiration date. if the stock price at this expiration date of the short, means the earliest maturity date, earliest expiration date, if the stock price is more closer to the strike price, then what we could see is the profit